channel. Today, we're diving into the fundamental concepts of finance, covering everything from risk management to portfolio optimization. Whether you're a beginner or looking to refresh your knowledge, this video has got you covered. What is finance? Finance is a broad term that describes activities associated with banking, leverages or credit, capital markets, money, and investments. Basically, finance represents money management and the process of acquiring needed funds. Finance also encompasses the oversight, creation, and study of money, banking, credit, investment, assets, and liabilities that make up financial systems. For further details, please visit official website of VMK Pros, website w.vmkpros.com. Many of the basic concepts in finance originate from micro and macroeconomics theories. One of the most fundamental theories is the time value of money, which essentially states that $1 today is worth more than $1 in the future. We have summarized the financial concepts as given below. 1. Risk-return trade-off. 2. Diversification. 3. Cost averaging. 4. Asset allocation. 5. Random walk theory. 6. Efficient market hypothesis. 7. The optimal portfolio. 8. Capital asset pricing mode. 9. Cost of capital. Let's understand each topic in details. Higher risk is associated with greater probability of higher return, and lower risk with a greater probability of smaller return. This trade-off, which an investor faces between risk and return while considering investment decisions, is called the risk-return trade-off. On the safe side of the spectrum, the risk-free rate of return is represented by the return on government securities, as their chance of default is essentially zero. Thus, if the risk-free rate is 6% at any given time, for instance, this means that investors can earn 6% per year on their assets, essentially without risking anything. Diversification is a risk management technique that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. The goal of diversification is to minimize the impact that the performance of any one security will have on the overall performance of the whole portfolio. As such, diversification lowers the risk associated with the portfolio. While diversification is a straightforward concept, the practical application can be quite complicated. Indeed, there are numerous complex formulas to demonstrate how diversification works. Here are the 3 main practices which can help to ensure optimal diversification of a portfolio. 1. Divide your portfolio among multiple investment vehicles, such as cash, stocks, bonds, mutual funds, and more. 2. Vary the level of risk in the securities in which you invest. Pick investments with varied risk levels. This will help to ensure that large losses are offset by gains in other areas. 3. Vary your securities according to industry. This helps to reduce the impact of risks that are industry-specific. For further details, please visit official website of VMK Pros, website vmkpros.com. Cost averaging investment is a method in which a fixed sum is invested on a regular basis, irrespective of the market trends. Thus, more shares are bought when the market prices are low and less when they are high. This results in fewer shares being purchased when prices are high and more shares purchased when prices are low. Over time, the cost per share tends to average out. Through this process, an investor reduces his or her risk of investing a large amount in a single investment at the wrong time. It is a strategy that also benefits investors who don't begin the investment process with a significant sum of money to invest. If you are able to invest smaller amounts regularly, you can ensure that you take advantage of growth over the long term. It is not perfect, however. It prevents a loss in a market which is suffering from steady declines. Still, over the long term, this strategy tends to be an effective one. Asset allocation is an investment strategy that aims to balance risk and reward by optioning a portfolio assets according to an individual's goals, risk tolerance, and investment horizon. The 3 main asset classes, equities, fixed income, and cash and equivalents, have different levels of risk and return, so each will behave differently over time. This concept of asset allocation is that older investors tend to look for lower levels of risk. After retiring, an investor may need to depend upon savings as the only source of income. Individuals at or nearing retirement age tend to invest more conservatively, as it is crucial that they preserve their assets at this stage. There are a number of general principles, but the most common approach is to shift emphasis towards lower risk instruments, like bonds and treasuries, as one gets closer to retirement. The random walk theory suggests that changes in stock prices have the same distribution and are independent of each other. Therefore, the past movement or trend of a stock price or market cannot be used to predict its future movement. In short, this is the idea that stocks take a random and unpredictable path. Essentially, this theory holds that stock prices take a random path, and one that is unpredictable. Regardless of what has happened in the past, the chance of a stock's future price going up is the same as the chance of it going down. Practitioners of the theory believe that it is impossible to outperform the broader market unless one takes on additional risk. This theory is decades old at this point. Many investors still hold that some or all of its ideas are true. Investors, on the flip side, believe that the investing world is quite different now than it was more than 4 decades ago. Today, relevant news and up-to-date stock quotes are available to virtually every investor, and investing is no longer limited to those who are privileged. Various managers have never believed that random walk is particularly valuable, not likely because they hold that analysis and stock picking are worthwhile means of making investment decisions. The efficient market hypothesis, or EMH, is an investment theory whereby share prices reflect all information and consistent alpha generation is impossible. Theoretically, neither technical nor fundamental analysis can produce risk-adjusted excess returns or alpha. Only inside information can result in outsized risk-adjusted returns. According to the EMH, stocks always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing, and the only way an investor can possibly obtain higher returns is by purchasing riskier investments. This hypothesis holds that it is impossible to beat the market, as prices in the market already incorporate and reflect all relevant information which may impact a stock. As you might imagine, this theory is highly controversial, and arguments about market efficiency still go on today. Those who believe in EMH hold that it's essentially pointless to look for undervalued stocks to try to make predictions of market trends using tools like fundamental analysis or technical analysis. As per this hypothesis, any time that an investor buys or sells a security, he or she is taking part in a game of chance rather than one of skill. A market that is efficient and current will always reflect the most accurate price, so one can never purchase a stock at a bargain price. Technical analysts largely dispute this theory. They argue that many investors base their expectations of stock performance on past prices, earnings, track records, and other backward-looking indicators. Stock prices are largely based on investor expectation, meaning that stock prices and activity in the past indirectly impact current and future prices as well. Technical analysts believe essentially the opposite of those subscribing to the EMH theory, that stocks are frequently misvalued in the market, and that sufficient research and wise decision-making can provide investors with an edge over competition. The idea of a portfolio optimization comes from the modern portfolio theory. Among other things, this theory assumes that investors focus their efforts on minimizing risk while also striving to attain the highest possible return. According to this theory, investors will act rationally within these parameters, and they will always make decisions with the goal of maximizing return for a given acceptable level of risk. Harry Markowitz introduced the idea of the optimal portfolio in 1952. This model shows that it is possible for different portfolios to have different levels of risk and return. This means that individual investors should determine how much risk they are willing to take on, and then they can allocate or diversify their portfolios according to the results of that decision. An individual investor can determine how much volatility he or she is willing to maintain in his other portfolio by picking another point which lies along the so-called efficient frontier. Doing so will provide maximum return for the amount of risk that the investor has decided to accept. Of course, optimizing a portfolio in practical terms is quite difficult and cannot be done easily. Today, there are computer programs and services which are devoted to determining optimal portfolios. The way that they accomplish this is by estimating different expected returns thousands of times over for each amount of risk. Capital Assets Pricing Model, CAPM, describes the relationship between an investor's risk and the expected return. It is designed to help model the pricing of higher risk securities. According to the CPM theory, the expected return of a particular security or a portfolio is equal to the rate on a risk-free security plus a risk premium. If the security or portfolio does not either meet or exceed the required return, then the investment should not be entered into. CAPM can be summarized according to the following formula. Required return or expected return equals risk-free rate plus beta, market return, risk-free rate. Cost of capital is used in discounting the cash flows of an enterprise while determining the present value of future cash flows. Cost of capital is equal to sum of cost of equity and cost of debt. Cost of capital equals cost of equity plus cost of debt, where both multiplied by appropriate weightage. Cost of equity equals risk-free rate of return plus beta. Expected market return, risk-free return. Risk-free rate of return is presently about 7.22%, which is the present yield on 10-year government bond. Equity risk premium equal expected market return, risk-free return. Beta of market is available from stock market data. Normally in India, 5.5% is recommended on equity market premium. Weighted average cost of capital is calculated by multiplying cost of equity and cost of debt by appropriate weight, which can be found from the debt-equity mix of the enterprise. For further details, please visit official website of VMK Pros, website www.vmkpros.com. Finance type, personal finance. Financial planning involves analyzing the current financial position of individuals to formulate strategies for future needs within financial constraints. Personal finance is specific to every individual's situation and activity. Therefore, financial strategies depend largely on the person's earnings, living requirements, goals, and desires. For example, individuals must save for retirement, which requires saving or investing enough money during their working lives to fund their long-term plans. This type of financial management decision falls under personal finance. Personal finance includes the purchasing of financial products such as credit cards, insurance, mortgages, and various types of investments. Banking is also considered a component of personal finance, including checking and savings accounts and online or mobile payment services like PayPal and Venmo. Corporate finance. Corporate finance refers to the financial activities related to running a corporation, usually with a division or department set up to oversee the financial activities. For example, a large company may have to decide whether to raise additional funds through a bond issue or stock offering. Investment banks may advise the firm on such considerations and help them market the securities. Startups may receive capital from angel investors or venture capitalists in exchange for a percentage of ownership. If a company thrives and decides to go public, it will issue shares on a stock exchange through an initial public offering, IPO, to raise cash. In other cases, a company might be trying to budget their capital and decide which projects to finance and which to put on hold in order to grow the company. These types of decisions fall under corporate finance. Public finance. Public finance includes tax, spending, budgeting, and debt issuance policies that affect how a government pays for the services it provides to the public. The federal government helps prevent market failure by overseeing the allocation of resources, distribution of income, and economic stability. Regular funding is secured mostly through taxation. Borrowing from banks, insurance companies, and other nations also help finance government spending. In addition to managing money in day-to-day operations, a government body also has social and fiscal responsibilities. A government is expected to ensure adequate social programs for its tax-paying citizens and to maintain a stable economy so that people can save and their money will be safe. For further details, please visit official website of VMK Pros, website www.vmkpros.com. That wraps up our discussion on the basic concepts of finance. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content. See you in the next one.